So I'm here with Steve Kaplan from the University of Chicago, world-renowned expert on private equity. What do you see going forward in the industry? We don't want to talk about performance, but sort of trends or people doing things differently. I mean, you mentioned operational performance, which I guess has been a trend for maybe the last decade, but
yeah, I mean that continues. The value creation teams continue. I think you've seen a lot of the funds, the private equity funds have, now private credit or direct lending funds. Yeah. That will continue because it's actually been a good thing in the U.S. and I guess Europe as well, that you've pushed some of the leverage lending out of the banks and to these private credit funds. And what's better about them being in the private credit funds is that, the banks, you're funding short-term deposits. These are long-term loans. There's that maturity mismatch, and there's risk, which the banks you maybe don't want in the banking system. The private credit funds, what's great is the capital is generally from pension funds or the people who are investing in the private equity funds, and that's longer term duration. So the maturity, you've got a maturity match as opposed to a mismatch. And that's where the private or the leverage lending has gone. Those funds themselves get leveraged about 50%, but it's only 50%. So you have to have a huge loss in value before it hits the banks. So the banks have basically, reduced their systemic risk. And if there are losses, it's going to go to the pension funds, which we don't want to happen. But at least there's nothing systemic. There's no run on the pension fund like there can be on the bank. So that move has actually been, I think, a good one. And that is likely to continue now, with more scrutiny on the banks and with the CLOs having issues in the 2021, 2022.
One thing though that puzzles me a little bit, because the private equity sort of partnership model with the fee and carry structure and the 10-year funds and all of this stuff, started in venture and buyout, but then went into infrastructure, went into real estate, now private credit. Now the thing that sort of I can't grasp quite is if you look at the PE model, and this I think you taught me this. If you look at the actual cost of assets under management, if you take the management fee and carry, you easily get to numbers like 6-7% of AUM, right?
5.
Yeah, 5. Okay, let's say 5 to 7,
which is high.
Which basically means for your LPs to break even, you have to do quite a bit of value creation, right? Which we know how that works operationally and so forth. To get an alpha of 5, 6, 7% to make your LPs whole. I can see how that can work in private equity. I can see how that can work in venture capital. But how would that work in private credit or real estate? I mean, the potential of doing the stuff with governance and so forth. Like if you're a private credit fund, or do they charge lower fees?
So the real estate and infrastructure, I think I agree. I'm not, their performance, on an absolute and at least relative to the public stock market has been lower. Now you can argue, there's a question of whether there are different risks or not. And real estate probably, infrastructure I'm not so sure. So that's one. Two, I think the fees are lower. I think the carry, trying to think, I think the carry tends to be lower on the private credit. It's more like 10 or 15, and the management fees are a little bit lower. You also have on all of them the preferred return, which is still 8% across the board. Now 8%, they were complaining was too high when interest rates were 0. Now interest rates are 5 or 6, 8 maybe too low. So anyway, but let's say interest rates come back down to sort of a 2-3% level. 8% is still protecting you. You're not getting a carry unless you deliver 8. And so that's gonna keep the fee down. On the private credit fund, the real estate and infrastructure are harder to say.
But do you have I know you've done some recent work on private credit. Do you think that there is some value creation, or is it just like, okay, there's we can get a higher interest rate just because it's a less liquid market, or do they actually do? It's
a little bit of a puzzle. So I think there are they're doing less than the private equity funds. The private equity funds are doing the heavy lifting. So they're doing less. On the other hand, what are they doing? They're charging usually, I want to say it was like LIBOR plus 6 to 8, and that's sort of that's like an equity risk premium kind of number. And this is the pre-tax number. Sorry, this is the pre-leverage number. Then they leverage it a little bit, and can get that the leveraged return to like a 10% spread. And then if you take out the fees, if you take out a 3 or 4%, you're still at an equity risk premium, a risk premium of 6% for something that doesn't have equity risk. So where that comes from, that's a question, and it's hard to answer. And it may come from the banks, just are not efficient, right? So they're more efficient. I do think some value comes from where they do add value. And we talked about this in the discussion, is the restructuring, that because they have some expertise, they have good information, and they have repeated relationship with the private equity firms. When it comes to restructuring the debt, if they need to, or getting more equity in from the sponsors, they're more efficient at that than the banks. Like the banks, if a company gets in trouble, you got to go to committees, and there's bureaucracy, and the private debt funds are right there.
Well, I'm wondering how much of this sort of inefficiency in banks, as you put it, come from regulation, right? So that we have to adhere to certain things because otherwise the capital charge would be too high, or we have to have this red tape because the regulator wants us to do all these
suspect
things.
it's part regulation, part bureaucracy.
Interesting. One maybe last thing. So ESG has been high on the agenda in the Nordics for quite some time. In Europe, I guess now more talk also about ESG investing or sustainable investing in the US as well, and it has affected the private equity industry. But it'd be interesting to hear your thoughts on that. Whether basically all of the big funds, I guess, have to have answer questions about ESG and responsibility, and also in the US.
So ESG is definitely a thing in the US. I think it's more of a thing where there's more demand for it in Europe than the US. But the US, there's definitely demand, and of course, European funds invest in US GPs. U.S. LPs invest in European. So there's a bit of a global developed country market. So the U.S. GPs have to address it. I think the big question on ESG going forward, which I don't think we know the answer, is what's value increasing and what's not, and whether and also value increasing for society versus value increasing for individual companies. And I think figuring out, what's value increasing and doing a lot of that. And then, for parts of ESG that are not value increasing, if that's the case, what happens there? Because, that's the place where it's tricky, because then, you may not want to do it. Your LPs may still want you to do it if it's value decreasing. And I think that's, kind of figuring out how to manage that is going to be interesting going forward. Although I think the private equity firms will be able to manage that better than the public companies.
I think one advantage that private markets might have in ESG over public markets is that they are way more active and way more informed about what goes on in their companies, it can actually change stuff. Because it's sort of hard to see that an ESG strategy, which basically just relies on, okay, I'm not going to invest in sector A, B, C, and D, like in the public market, that you can make money that way. I mean, it seems it's very hard to say by choosing not to invest in certain things, negative screening. Well, okay, you can't get higher return. You're taking something off, and more money goes into that. So there's a easy to see that there's a trade-off. But if you're in a private market, you can actually do something with the company. You can change the company, and to the extent that then results in a higher valuation when you sell, you can
there's probably some of that. But and then whether you're investing in a particular company, whether it's public or private, I think then the public companies, there's going to be a tendency to do everything.
Yeah.
In a sort of check the box way, whereas the private equity investors can be a little more. Yeah.
So Steve, it's been a pleasure having you here. Please come back soon. Well, thanks for making the long trip to Stockholm.
Good. Well, thanks for having me. It is always a pleasure to visit and spend time with you.